In May 2019, the bustling streets of New York City set the stage for a pivotal moment in financial history. The New York Stock Exchange, with its iconic facade, braced for the arrival of a giant. Uber Technologies Inc., the ride-hailing titan that had reshaped urban mobility around the globe, was set to go public. Anticipation buzzed through Wall Street as Uber's initial public offering, IPO, was expected to reach a staggering valuation of approximately $82 billion. Investors and analysts alike speculated about the potential of this tech behemoth. They pondered whether its public debut would solidify its status as a market leader or reveal vulnerabilities beneath its high-flying exterior. Founded in 2009, Uber's rise was nothing short of meteoric. The company had rapidly expanded across continents, offering diverse services from ride-hailing to food delivery and freight logistics. By the time it filed its S-1 with the U.S. Securities and Exchange Commission in April 2019, Uber was operating in over 60 countries. Uber was completing billions of journeys each year. The financial data was both impressive and concerning. Uber reported a revenue of $11.3 billion in 2018. Yet this growth came at the cost of a $1.8 billion net loss. As Uber prepared for its IPO, the central question loomed large. Could public investors be convinced of its long-term profitability? Before its public debut, Uber had already been an alluring target for private investors. Venture capital firms had poured billions into the company, valuing it at up to $76 billion in private markets. Uber's strategy was clear. It prioritized aggressive global expansion, enticing driver incentives, and the development of cutting-edge technology infrastructure. These investments made Uber one of the most valuable private startups ever, setting high expectations for its IPO. In the run-up to the public offering, Uber embarked on an IPO roadshow. This was a critical phase where executives sought to win over institutional investors. During these presentations, Uber laid out its ambitious plans. The prospectus revealed intentions to raise around 8 billion pricing shares between $44 and $50 each. Uber's pitch focused on its massive market scale, potential for long-term growth, and strategic expansions into the delivery and freight sectors. Enthusiasm was palpable, yet questions about profitability lingered. The day before Uber's stock was set to trade publicly, the company priced its shares at $45. This was near the lower edge of the anticipated range. This pricing valued Uber at roughly $82 billion, a figure that reflected both optimism and caution. On May 10, 2019, the New York Stock Exchange echoed with anticipation as Uber's shares began trading under the ticker symbol Uber. The opening bell marked not just the start of trading, but the onset of a public examination of Uber's business model and future prospects. As the trading day unfolded, it became clear that the market's response was tepid. Uber's stock closed at approximately $41.57, down about 7.6% from its IPO price. This first-day performance marked one of the largest dollar losses for a US IPO at the time, surprising many who had anticipated a more robust reception. The broader market conditions were challenging as well. Trade tensions between the United States and China were escalating, injecting volatility into the global financial landscape and affecting investor sentiment. A deeper dive into Uber's financials revealed the core issue. Profitability remained elusive. The company's S-1 filing showed accumulated losses in billions since its inception, raising concerns about its path to financial sustainability. Investors scrutinized Uber's cost structure, questioning whether the company could achieve profitable growth amid fierce ride-hailing competition, looming regulatory expenses, and ongoing debates about driver classification. It was a scenario where scale and innovation were not enough. Uber needed to demonstrate a clear trajectory toward sustainable earnings. In the aftermath of the IPO, Uber's journey was far from over. The months following its debut saw further declines in share prices, prompting the company to reassess its strategies. Cost-cutting measures and strategic shifts were implemented as Uber navigated the challenges of being a public company. The narrative was evolving, and the story of Uber's IPO was only just beginning to unfold. The complexities of its initial offering raised broader questions about how Wall Street values high-growth technology companies. This set the stage for ongoing discussions about the balance between growth and profitability in the tech sector. As Uber navigated the turbulent waters of its post-IPO landscape, the company faced growing pains that were emblematic of its dual identity as a tech innovator and a transportation giant. The immediate aftermath of the IPO saw Uber grappling with a fluctuating stock price, which dipped significantly below its initial offering value. This volatility was not only a reflection of broader market conditions, but also an indicator of investor skepticism about the company's long-term profitability strategy. One of the pivotal figures in Uber's journey was its CEO at the time, Dara Khosrowshahi. Brought in to steer the company through its public debut, Khosrowshahi was tasked with transforming Uber's image. His leadership style focused on transparency and accountability. This was a shift from the aggressive, growth-at-all-costs mentality that had characterized Uber's earlier years. Khosrowshahi's role was crucial in navigating regulatory challenges. He improved corporate governance and addressed cultural issues that had previously plagued the company. As investors scrutinized Uber's financial health, profitability became the central theme of discussions. The company embarked on a series of strategic moves aimed at cutting costs and optimizing operations. These included reducing driver incentives, streamlining corporate expenses, and exiting unprofitable markets. Uber also faced the challenge of legal battles concerning the classification of its drivers. The debate over whether drivers should be considered employees or independent contractors posed significant financial implications. This affected labor costs and regulatory compliance. Meanwhile, Uber's competitors, notably Lyft, were also under the microscope. Lyft had gone public just weeks before Uber. The performance of these ride-hailing giants was seen as a litmus test for the sustainability of the gig economy business model. Investors were increasingly cautious, demanding clearer paths to profitability. They wanted a more robust demonstration of value generation. In the midst of these challenges, Uber was not standing still. The company was aggressively investing in diversification, particularly through its Uber Eats division. As ride-hailing demand fluctuated, Uber Eats emerged as a critical growth engine. The food delivery segment was rapidly expanding, capturing a significant share of the market. This contributed to Uber's revenue streams. This diversification strategy was not only a hedge against the volatility of the ride-hailing business. It was also a strategic move to capitalize on changing consumer behavior. As the months rolled on, the global landscape shifted dramatically with the onset of the COVID-19 pandemic in early 2020. This unprecedented crisis hit the transportation sector hard. Ride-hailing services experienced a sharp decline in demand as lockdowns and social distancing measures were implemented worldwide. For Uber, this was a double-edged sword. While its core business suffered, the pandemic accelerated the growth of Uber Eats. The division saw a surge in orders as consumers turned to delivery services amidst restaurant closures and the necessity for contactless transactions. The pandemic also prompted Uber to reassess its business priorities and accelerate its push towards operational efficiency. The company announced several cost-cutting measures, including layoffs and the consolidation of its workforce, which were essential to weathering the economic storm. These actions, coupled with strategic partnerships and acquisitions, were part of a broader effort to stabilize the business and chart a course toward profitability. Amidst these strategic shifts, Uber continued to invest in future technologies. The company explored avenues such as autonomous vehicles and urban air mobility, reflecting its ambition to remain at the forefront of innovation in transportation. These initiatives, while still in developmental stages, represented Uber's vision of a future where technology could redefine mobility once again. As Uber's story unfolded, the company became a symbol of the broader challenges facing tech-driven enterprises as they transitioned from private to public entities. The scrutiny of Uber's IPO and subsequent performance highlighted the evolving expectations of investors who were increasingly demanding sustainable business models and clear profitability timelines. This shift in investor sentiment marked a significant turning point not only for Uber, but for the entire tech sector, where the balance between rapid growth and financial discipline was being re-evaluated. With each quarter, Uber's financial reports became a focal point for analysts and investors, offering insights into the company's progress toward its profitability goals. The narrative of Uber's journey from startup to public company continued to evolve, marked by strategic pivots and the relentless pursuit of innovation. The challenges and triumphs of Uber's post-IPO life were reflective of the dynamic and often unpredictable nature of the technology industry, where the only constant is change. As Uber pressed forward, its story remained a compelling testament to the complexities and potential of modern business in a rapidly changing world. By 2021, Uber's narrative had shifted significantly as it began making strides toward profitability, driven largely by the strategic expansion of its delivery services. The company's acquisition of Postmates for $2.65 billion in an all-stock deal in December 2020 bolstered its delivery operations, enabling Uber Eats to compete more effectively in the crowded market. This strategic move capitalized on the pandemic-induced surge in delivery demand and represented a decisive pivot in Uber's business model. Uber also expanded its footprint in the mobility sector by acquiring Drizzly, a leading alcohol delivery service, for $1.1 billion. This move further diversified its product offerings. These acquisitions underscored Uber's commitment to building a comprehensive ecosystem around its core competencies. Uber leveraged its extensive logistics network to deliver a variety of services beyond traditional ride-hailing. Despite these advancements, Uber continued to face regulatory hurdles and competition. The ongoing debate over driver classification remained a contentious issue. Legislation like California's Proposition 22 shaped the future of gig work. This proposition allowed app-based transportation and delivery companies to classify drivers as independent contractors while providing certain benefits. It was seen as a victory for Uber, although legal challenges persisted. As Uber adapted to these evolving dynamics, the company maintained its focus on innovation. Uber invested in electric vehicle partnerships and sustainable transport initiatives. These efforts reflected its long-term vision of reducing environmental impact and aligning with global sustainability goals. By 2023, Uber achieved its first annual operating profit, a milestone that marked a new chapter in its journey. Through resilience and adaptation, Uber had transformed its narrative from a high-growth startup to a multifaceted, publicly traded powerhouse.